Hi, I'm Mehdi Sanaji and welcome to Your Finance TV. I'm wishing you a very happy Friday, and that can mean only one thing. Scott's off playing golf, but I have the great pleasure of talking with the one and only Jay Pulaski of TPW Advisory about his Friday musings. Jay, welcome.
Marty, it's a welcome change to see you instead of Scott. I was getting bored with Scott, so
I
thank you
know
so much for
we
coming.
are
I'm
long
sure the questions are going to
overdue.
be much better now.
There we go. We've been long overdue. It's been a while, so I'm really
It,
excited to jump in on your musings. And
yes.
it seems like a doozy this week. The title is a rotation. So before we dive into some of the nuances of your rotational thoughts, why don't you run us through your process on how you're looking at things at TPW Advisory?
Yeah, well, today, I mean, that's a great question for today because I do lead off the musings with some thoughts about process because this is actually my second video or TV hit of the day. I was on Bloomberg this morning, that other network, and it's interesting how it works, right? Last week for us is like our busiest week. We finished the monthly, which is a pretty big lift for us, right? About 5,000 words, typically 20 to 25 charts from 15 or more independent research sources. So that's a big lift. Then we go into our model portfolio updates, right? Remember, we have our global multi asset flagship and then our TPW 20 thematic model, both 100% composed of ETFs. So we do that. We send out a client note to the clients who subscribe to the model delivery service. And then we write another musing. So that's all in the space of a Friday to Friday. So that was last Friday. So this week, is tends to be like my first week to kind of relax. And typically when that happens, that's when the nuggets kind of make themselves known, right? Because you're doing all that work to get all those things done. And oftentimes it's the real insight doesn't really make itself apparent till you've had some time to separate and digest. And so yesterday I'm at the gym and some thoughts come to me around this idea of rotation around big cap tech. And that's what a lot of people are talking about. Everyone's trying to understand it. So I had some really interesting thoughts, and I'm excited to come back to the office and write them down in preparation for today's musings. And I get an email from Bloomberg asking if I can come on this morning. And I go, perfect. So I write up my notes in preparation for the hit this morning. And then lo and behold, at 8 o'clock this morning, they hit me with a topic change. And so all of a sudden it's going to be a different topic than the one I wrote up. So that became the second part of the musing. So we can kind of give thanks to the Bloomberg folks, that other network, for helping us write today's musings, which is on rotation.
So Jay, firstly, I can't thank that other network, can I? But we'll give them a little nod somewhere along the way. But we're grateful to have your content and go through them right now. So we have two different themes on rotation. Why don't you
Right.
run us through the first one now?
Sure. So there's a rotation that is to come, and there's the rotation which is underway. So the one to come, we think, is the rotation from big cap tech to cyclicals and commodities. And we've been paying quite a bit of attention to big tech. We're believers that AI is for real and it's kicking off a new innovation cycle that's going to have major implications for U.S. economy and for the global economy. And in essence, it really made us think about big cap tech because we've been negative and underweight tech for well over a year based on the view that high interest rates are negative for technology stocks. And that, of course, led to a significant derating of big cap tech last year. So it worked out perfectly. And then you've had the situation where you have AI come in. You've had a big spike in the queues because AI is really got a kind of moat that comes with it, namely how expensive it is to run the large language models that underpin what we know as AI today, insofar as it's been rolled out. So big tech has a moat. The rate fears that we had expressed last year are now finished. We think the Fed is on hold. We don't think they're going to raise rates anymore. And so big tech also serves as a nice hedge against inflation, right? Or recession, sorry. So recession equals lower rates equals good for big tech. So now we've had this divide, right? We've had big tech cues on a new bull market, up 20% year to date. Cyclicals underperforming because people were expecting and pricing in a recession. Commodities underperforming for the same reason. And so now we think the question is when, not if, we're going to rotate back to cyclicals to allow the whole market to move up. And the way we see it playing out, and one of the things that differentiates TPW advisory is our forward focus. We're relentlessly focused forward. We're not going to talk about all the stuff that's happened in the past. So going forward, we think the June Fed meeting is going to be key. We expect the Fed to validate the going on hold. And more importantly, we expect the Fed to significantly increase its GDP forecasts for 2023 and 2024. That's going to validate the middle path that we've been talking about between high inflation and deep recession, validate that middle path, validate the earnings increases that people are starting to pencil in for the second half of the year, validate the forward corporate guidance, which has gotten much better over the last reporting period, and most importantly, validate the move from big tech back into, to some extent, back into cyclicals and commodities. And so we think that's the way things are going to play out. And that rotation means for us in our global multi-asset model, we're kind of running a barbell. So we have, over the last several weeks or more, been adding to US tech, and including the semiconductor space, which we really see as the pick and shovel of AI, right? Because all this demand for computing power means greater and greater demand for the highest quality chips, of which there are only a handful of people who can produce them. And so we have exposure there. And then we have on the other side of the barbell, cyclical exposure. So we have the home builders, we have the transports, we have the financials, big cap financials, not regionals, and we have the industrials. And so that's the way we're playing things at the moment in the US equity piece of our global multi-asset model. Believers in AI, believers in that makes big tech more attractive on a relative basis. That's been expressed with a 20% move. Waiting for the move in cyclicals and commodities. That's going to be kicked off by the Fed, validating the on hold, and more importantly, raising their growth forecasts for 2023 and 2024.
Fantastic. Thank you for breaking that down. And it's always helpful having that barbell analogy as well when you run through things. So that's a great visual.
Yeah, and it's one of those things, Monty, that, again, kind of the insight that comes to you, right? Because it's, the move back into tech for us was kind of, took a little bit of time, and I don't think we're early on it. As I said, it's only been in the last few weeks that we've made that move. So we're certainly not early, but we don't think we're late either. And so I think tech can continue to do okay. It's just had a big run and needs to rest. Most of the pieces are approaching overbought conditions. If you look at RSI, for example. So now when you look at commodities, which the Bloomberg Commodity Index hit a 16-month low last week. So that gap is stretched. So now we played this, and now we want to play the one that's going to come up. And we have that catalyst, which is only less than a month away, because the Fed meeting in June is the 14th. So less than a month away, we're going to have that Fed validation, and that's going to take that segment of the market higher as well.
Important Fed meeting. So what's the second part of your rotation?
Well, the second one is one that's kind of underway, as I suggested, and that's really the rotation from U.S. equity leadership to the rest of the world leading global equity markets. And recall, for history's sake, that the U.S. has been the biggest game in town really since the low in 2009, right up until about 8 or 10 months ago, when, surprise, surprise, the curtain of FUD, right, which we call fear, uncertainty, and doubt, that's the FUD, the curtain of FUD, which had descended on Europe in particular following the Russian invasion of the Ukraine, started to lift when it became clear that the energy picture was not as dire as the naysayers had expected it to be. And so Europe has really been the leader. Europe's up about 30% in dollar terms over the last year versus the S&P up about 6. So it's really been a developed market, ex-US leadership process here. And now we see Japan coming along as well. And while for us, Europe was really the story last year, we've been overweight European equities, particularly focused on the banks for well over a year. So Europe was really kind of last year's story for us, and we're still holding the bulk of those positions, still overweight Europe. But our real attention this year has been towards the Asia Pacific region, and in particular in the developed market space, Japan. And so Japan is starting to break out. EWJ just hit a new 52-week high. And the reasons are pretty straightforward. Japan is finally exiting structural deflation, which has bedeviled the country really since the 90s. And so inflation today in Japan is a welcome thing, unlike in the US and Europe. It's running about 3.5% to 4%. Wage gains in Japan this year in the spring wage round was about 3.5% to 4%. And so Japan just printed the strongest Q1 GDP result of any of the G7 countries. And of course, the G7 is meeting in Hiroshima this weekend, and Prime Minister Kishida is letting his peers know that Japan has got the strongest growth going of any of the G7 countries. So this all helps to explain why Japan is starting to really work. And EWJ is up about 11 or 12% year to date versus the S&P up about 9. So it's not huge outperformance, but it is still outperformance. And we think there's more to come, particularly with the expectation we have that the Bank of Japan is going to exit what's called yield curve control, where they're capping the interest rates that the JGBs are able to offer by basically buying them up whenever they need to keep the cap. We think with inflation now at 3.5% to 4%, they're going to allow rates to rise in Japan. And we think that's going to lead to a significant shift in domestic investor allocation away from bonds into stocks. And so that's going to be what takes Japan continuously higher in the second half of the year. So we're really right now, in terms of like most overweight non-US is in the developed markets. The biggest overweight is now in Japan.
That makes sense, especially after the reaction yesterday with the higher CPI print that they had. There was no knee-jerk reaction of having to raise rates or anything like you'd see in the more European and US-centric regions.
Exactly.
Jay, first of all, thanks for breaking that all down. What about emerging markets? You've also kind of had a focus on China over the last several months as well. Are there any other regions that that have popped up of thought?
Yeah, well, you're right on it, Marty, and it's a little bit of there's the good stuff we've talked about, and then there's the not so good stuff, which we'll talk about now, and that's really China, which has been pretty disappointing as an equity market. We were pretty constructive again with the exit from zero COVID in the fall, and we had that big move up, particularly in KWEB, the China Tech ETF. As well as the broader ETFs for China. But that's really kind of dissipated. And year to date, broad China is down about 4%. KWEB's down about 12%. So again, a huge gap between Q's up 20, KWeb down 12. And I think there are a couple of things going on. First of all, you have, as in the US, cash deposits in China yield about 3.5 to 4%. They have virtually no inflation. So that's like a 3 to 4% real return on cash. So that's a challenge for equities. And then in addition, they're still coming out of zero COVID. That was less than 5 months ago. So consumer confidence, while becoming better, and demand is picking up for sure and significantly, but the desire to take risk in the equity market is not really manifested. And then from the foreign investor side, there's all this geopolitical talk about China and the US and the Cold War and sanctions. And so China tech, I think, has really borne the brunt of that particular issue around geopolitical risk. And so China's been a disappointment. We have shifted some of our exposure from China to Japan, keeping it in the Asia Pacific region, but focusing more on the one that's breaking out as opposed to the one that's breaking down. Now, we also do have some markets we like and that are performing well in the emerging markets. And the real poster child right now is Mexico, right? We have our tripolar worldview, thus the name, TPW, tripolar world, which argues that regional integration in Europe, Asia, and the Americas is the way the global economy is moving. And we see that unfolding in real time with the supply chain realignments, particularly around electric vehicles and semiconductor fab plants, right? Every region needs to have their own supply chain, right? In the US, that's the Infrastructure Act with the climate components there. It's the CHIPS Act to encourage semiconductor production in the US. Same things happening in Europe, same things happening in Asia, where increasingly people are talking about China plus one, right? So production in China, mostly increasingly for China domestic demand, and then plus one being another production platform in Asia, whether it's in Thailand or Malaysia or Vietnam or India. That's the thesis there. And one of the ways we're playing that is through a position in Southeast Asia, a Southeast Asian ETF. But the real winner year to date has been Mexico. Actually, it's the best performing major market year to date, up about 20%. The currency is the strongest currency in the world versus the dollar. It's at a 6-year high versus the dollar. And it's all because Mexico is the big winner from the production moving into the US, with a big piece of that production also setting up across the border in Mexico, where where producers can take advantage of lower costs, but still qualify for the subsidies and benefits that are attached to producing in North America. So Mexico has become a huge winner, and that's been a real success for us, and we again expect that to continue. The peso is strong. Interest rates are high. They have real rates of about 5%. And we do expect that as the Fed goes on hold, the emerging market central banks, who have already gone on hold, both Mexico and Brazil, for example, their central banks are already on hold. So they're ahead of the Fed. Once the Fed goes on hold, we expect these central banks to start cutting to help stimulate their domestic economies. So as I said, Mexico has real rates of about 5%. Brazil, for example, has real rates of about 8%, real, after inflation. So there's plenty of room to cut. And we think that's going to be the story of the second half of the year. We're ending the inflation spike post-COVID. We're ending the rate hike cycle, and we're about to kick off a rate cutting cycle led by the emerging markets. And so our big thesis is that we're early cycle in the global economy, early cycle in a recovery, not late cycle going into recession, which is where most people are positioned. And so here again, we have the barbell where we have the US exposure with a little bit more of that, given our view on tech has changed, and then non US exposure with a focus primarily on developed ex US, as well as some specific emerging market countries like Mexico, like in Southeast Asia. And then the other way we're playing, and I'll stop here, is we have a pretty big position in emerging market local currency debt because we believe as the Fed goes on hold that the dollar will resume weakening, emerging market currencies should strengthen. And as they cut rates and their economies start to grow, capital comes in, currencies go up. And so we have one of our bigger debt positions is in emerging market local currency debt. So that's the way we're playing things. Barbell seems to be the way we're thinking about it. Barbell between big cap tech and cyclicals within the US equity exposure, and then overall global equity exposure, barbell in the US with non-US exposure, particularly in the developed markets of Europe and Japan.
That's very interesting. Thank you for that breakdown. And it's particularly fascinating listening to how Mexico has become like a win-win situation. So definitely
Yeah,
something.
it's not really appreciated by many
No,
people, right? Which is so funny. You know, when you in this country, Mexico constantly gets a bad rap. I'm sure if you ask even sophisticated investors, right, what market is the best performing market, major market in the world year to date, and which is the strongest currency year to date?
it's an
I
eye-opener.
think very few people would say Mexico and the Mexican peso. And yet that's a fact. And that's one of the reasons why, if you want that kind of analysis, if you want that kind of insight, we're the people to come see. We've been in Mexico for a good 6 months or more with a significant overweight vis-a-vis our benchmark. And so that's one of the positions that have really helped us this year. So it's always good to have a chance to talk about it with you and your colleague, Mr. Duxbury. Please give him my regards whenever he gets off the course. And you and I, let's finish up and have a great weekend.
Absolutely. And Jay, I want to make sure our viewers really appreciate the fact that they should be reading the TPW advisory notes and research that you're putting out because you are ahead of the curve. It's actually very thought-provoking content and really appreciate you sharing your thoughts on your Friday musing this week.
Excellent, Marty.
And of course, don't forget to subscribe to Your Finance TV. The subscribe button's down there somewhere. And, have a great weekend and good luck investing.